Hi, Chris here, Colorado mortgage lender, and today I wanted to talk briefly about private mortgage insurance, also known as PMI, what it is and why we have it. PMI is typically attached to a conventional loan if your down payment is less than 20% of the sales price. It's typically a monthly premium attached to your mortgage, but it doesn't have to be. It can be a lump sum paid up front. It can also be paid by the lender. In return for this, you would have a slightly higher interest rate on your mortgage, which would yield a lender credit that would pay the lump sum mortgage insurance premium. Or it can be split. Instead of a one-time lump sum or a monthly premium, you could pay some money up front to have a slightly lower monthly premium. Any of these options could be more effective if you have seller concessions involved in your home purchase transaction, i.e., the seller is willing to pay something towards your closing expenses as a concession on your mortgage. So we shop for PMI on your behalf, and the amount you will pay varies firstly on how much down payment you have, whether it's 3% down, 5% down, 10% down, or 15% down. It also varies based on credit scores and how many borrowers are on the loan. Private mortgage insurance is issued by private mortgage insurance companies. We shop for the insurance for you on your behalf through a network of insurance companies that we're connected with. There's at least half a dozen providers, and their rates will differ on any given day. We use pricing engines to shop around to find you the best rate at the time. How do I get rid of PMI, you ask? Well, unlike FHA loans, PMI will disappear from your mortgage when your loan balance reaches 78%, or rather, you have 22% equity in the home. So if your loan balance gets paid down to 78% of the value of the home when you purchased it, your mortgage insurance premium will drop off your mortgage automatically. But as you can imagine, this can take several years. You can take steps proactively to remove your PMI premium sooner as the value of your home appreciates. If your loan is 2 to 5 years old, once your loan balance is 75% of current home value, you can apply to have the PMI premium removed. If your home value is increased due to improvements you've made to the home, you can apply also to have the PMI removed when your loan balance reaches 80% of the current home value. Your loan servicer will typically charge you for an appraisal to determine the current home value and determine if you can have PMI removed. So the myth is that you don't need 20% down to finance a home. You can have less than 20% down with mortgage insurance and get into a home and start building equity that much quicker. Because mortgage interest rates and pricing is risk-based, there's slightly less risk involved in a loan that has PMI. What are the benefits of PMI? It insures the lender in case of default. It's a premium paid by a home buyer, a homeowner, to insure their lender in case they default on the loan. So, for instance, if you have 15% down on the home purchase, you may obtain a very, very slightly better interest rate on your mortgage than you would if you had 20% down. Not always, but occasionally the pricing works in your favor. So if you have any questions or need more information about PMI and how it works, feel free to reach out. Otherwise, thanks for watching, and we'll look forward to speaking with you soon.